Pick up, I think, where they left off last meeting. I had to leave earlier, I'm sure. So you guys are going to start, turn it over to you.
Well,
Yeah, go ahead.
I just asked here to answer questions with board members after we had time to look over through the audit. I know Dan, he had some questions. Matt, Ted, do you have any specific questions about the audit after you looked through it?
I think that, because you and I had the opportunity to meet with Jim prior and ask a lot of our questions, you know, I think that my questions and subsequent request of the jail expense and revenue statement seem to answer the majority of my questions, so I don't have any more pertinent at this point yet.
Okay, well, I'll start. On our audit, it showed our expenses for transportation went up $900,000. It's page 15. Can you kind of clarify why that showed such a huge increase? Is that because of FEMA money or?
What page was that, 15?
I think I on page 15.
Yes, increasing, I think you're going to see increases in revenue also. So I think it was grant money that came in and was spent, because we're up 900,000 in expenses, you're right. But we're also up in grants, operating grants, you know, 450,000. And even charges for service around a couple $100,000. So I did have a note here about that cost increase. We've had so many drafts here. I wonder if I had another draft, but I think that was, I know we had a couple instances where the expenses were up because there was additional revenue to fund those expenses for specific projects, like grant revenue. And I know the grant revenue was up, maybe not the full 900,000, but up a pretty good amount there. Do you have anything on that, Dave? Anything further in your notes? Capital grants are not, no, they're not. But yeah, the operating grants and contributions are up. Between the two of those, charges for service and that, you're up, what did I say, 400, 600. Yeah, not the 900, but you know, 600 and some thousand on the revenue side. Would that equate on the fund statement to what category? Is that what you're looking at? On the county, just on the highway fund itself, revenues. So in what category are those revenues in? The intergovernmental revenue is up 700,000. Yeah. So I thought we had some notes on that, exactly what the project was, but there was, I think, some projects going on that had the funds coming in, so obviously there's spend that's shown as an expenditure. That's why the expenses are up there, because yeah, the bonds, right. For the, because the highway is most of what's over here, you know, obviously in the transportation. I mean, this is in the entity-wide statement. In the fund statement on page 18, you know, does not have the depreciation number. So that's your big difference between the expenses for the two. Because this one over here on 15 includes depreciation, that $2.5 million. Includes depreciation, which could be part of the increase also. Can you check that? You know, depreciation amount, that could be part of it also. But the fund itself, there's additional revenue and additional expenses, so that the net there is about the same as what it was last year, Jeff, on the highway itself. But it shows a loss of $359,000 on the highway.
Yep.
And that was about the same amount last year, $333,000. Yeah. So it wasn't like we had an additional $900,000 loss.
Okay.
Because of this additional expenses. Loss was about the same, so the revenue was almost matching.
Okay, so the cost of the highway department was similar to what was your previous.
Yeah. And I mean, there's probably more than one project. Right. There's probably several projects, but would that be the same audit? That's those have been, yeah.
If you look on page 57, it basically has a breakdown of the highway department, and we're showing as an expenditure $556,000 to FEMA, but yet we're not showing that as revenue. And actually, we received over $556,000. And I seen in your notes somewhere where we know grant revenue and other revenue accounts for disbursements netted against the corresponding revenue.
That's probably in the intergovernmental revenue.
Well,
The FEMA revenue.
looking at this, it makes the highway department look like they're $500,000, well, actually over $1 million over budget, because there's another one up there for road maintenance material, repair material, where they actually had revenue coming in. If you're doing a budget on the highway department, why wouldn't, I mean, you're breaking down each department, why wouldn't that show up as revenue up here, and also show up as revenue in the general fund and the overall net expenditures?
Yeah. I don't know on the budget side, and maybe that was netted rather than shown in two places on the budget itself. And that could be that was, because really the bottom line is a little different than the budget, but yeah, those individual line items are off quite a bit from budget. The expenditure being not even budgeted for on the expenditure side. But, you know, obviously the fees part is quite a bit over what the final budget was, and the intergovernmental is quite a bit over the final budget on the revenue side.
Actually, there should have been like a $70,000 extra revenue, because that FEMA grant came in to Jimmy. He wrote out the checks for it to the different townships, which left our area with $70,000. So there should have been, you know, somewhere in here an additional $70,000 revenue off of that.
Well, and it could, yeah, I mean, the intergovernmental revenue is $778,000, and the FEMA expense is $556. I don't have a breakdown of that $778 right now, you know, to really, but it's, there very well could be that excess 70 could be there, and then there's something else in there too, in that intergovernmental. How much was that the year before? Page 7. Let's see.
I think it just didn't show up. The money coming in, money going out just didn't show up on the same page. That's what's confusing.
Well, and it should.
I agree, but I think that's what the issue is.
Yeah.
It shows up on a different page.
Yeah, because Jimmy's like,
It's still-
well,
it was still
I
money
received a
that
check
came
for
in,
this
money
much
that went
money, I
out.
wrote out the check, so why wouldn't it go right underneath Jimmy's account?
Yeah. I mean, just look at that one page, you're right. It looks like we're $500,000 in the hole there.
Yeah, and then
But
another
really, we're not. 'cause that shows up
$500,000 on the
a
road
different page.
maintenance, and Jimmy explained that.
Well, and the other thing you gotta understand, you know, because the budgets are done on a cash basis, these actual numbers back here are presented on a cash basis, which is not what the rest of the statement is. It's on modified accrual, so if there's any accrual items, like bills sitting there not paid, they're not gonna show up back here. They would show up in the rest of the statement, but not in this comparison to budget. So, it makes it a little difficult to make that comparison, but we have to compare it to the same basis that the budget was done in. So, you know, these numbers won't tie exactly to that statement up on page 18 or whatever it was, because that's on modified cash, or modified accrual, I mean, and this is a cash basis. But you're right, sometimes things, it's hard to track things through. We do this all the time, trying to, you know, it may come into one, but it may be transferred back out, or there, you know, there's several funds that you have to take into account on a particular transaction, you know, to follow it through.
Well then, on page 6 and 7, I'm just asking, because I'm not understanding this account.
Okay.
There's a, page 7, the second paragraph, the county's total net position increased by $1,335,000.27. But yet, you have your 2012 total net position of $9,647,000. The 2013 is $11 million, and you subtract them two numbers, and that don't even come out to the increase of $1,335,000.
Are you following? You're on page 7?
Yeah, it's actually $210,000 difference in just subtracting them two basic numbers. Comparing the total net position down here on page 7, which is $9,647,000,
Right, okay.
and then the total net position in 2013, if you subtract them two numbers, it comes up with $1,545,000, not the $1,335,000 that you have in the second paragraph.
I think you need to look at your first set of number has business type activities, and it looks like we should go governmental to governmental activities. Is
Well,
that difference, the 10.9 minus the 9.6, that's our 1.3, I believe.
What you're saying in your audit position, though, as far as your government-wide net position, these are the net numbers, plain and simple, from what I'm reading here.
But just to go, see, for 12, we only had governmental activities.
That's right.
And for 13, we've got farm in here now, so we've got governmental and business type. We didn't have the business type in 12. So what, like Dave was saying, I mean, yeah, you'd compare the $9,647,000 to the $10,980,000, not to the $11,193,000.
Okay, gotcha.
Yeah,
That makes sense.
okay.
That's why I'm asking.
Okay, that's fine.
Now, our increase in our debt service represented the paying back of the tax anticipation warrants too that we accrued earlier, right?
You know, we talked about this on the
Yeah.
phone, and then this is another quirk here, because the anticipation notes, normally in a government, your government-wide will show, the debt, and you don't show payments as expense here. In the fund statements, you show it as expense. You never book a long-term liability in the fund's financial statements. With those anticipation notes, you do. So those are booked as a liability, so the repayment of those notes does not show up as an expenditure. So I misspoke when we talked on the
Okay.
phone, I wasn't, yeah. So there's other repayments in there that were new to the general fund this year. Line of credit notes, that $500,000 that was repaid. But that does show as an expenditure in that general fund, and it was a couple thousand the year before. So that's a major change in that negative balance in the general fund. That's true, and we talked about that. But it is not those anticipation warrants.
Okay.
Yeah.
So it was other
debt.
debt we paid.
Yeah, we don't consider those, or governmental standards don't consider those long-term debt.
Okay.
So it's the long-term debt that is shown that way, and that's what I was thinking about long-term debt when we talked, but the anticipation debt is a short-term debt. So it does get booked as a liability, just like any company, you show it as a liability when you bring it in, and you pay it off, you show it, paying off the liability, and it doesn't go through the revenue or expense at all. Yeah, so, but there is there's the line of credit payments, money coming, being drawn out of it, and money paying back. So when we were talking, I think, Jeff, about the general fund, and that was a major, that was $500,000 that we didn't have last year.
That we paid on this year.
Paid on, yes,
Right.
yes.
And that was previous accounts we owed on.
Right.
Right. So it wasn't really loss in last year, it was lost in previous years before that.
That had to be
carried
funded
forward.
with debt, yeah.
Okay.
Yep.
And then on page 15, I noticed since 12, our general revenues had increased $1.1 million then in 12.
In 2012.
What page were you?
15.
Okay, what number are you looking at there? For last year?
General revenues and are we same pages on both these, are we?
They should be pretty close. The first ones will be. Well, no, they're not, unless there's a page off. Yeah,
Yeah,
so
page off.
it's 18 on this year's and 17 on last year's. Mm-hmm. Mm-hmm. Right. We're looking at the funds, aren't we? That's
Total
still-
general revenues, yeah.
So the 1 point, yeah, I'm not sure. Oh, you're back on the entity wide?
Yeah.
Okay,
That's page 15.
and 14 last year. You're looking at last year's? Okay.
And you're looking at the total column, right, Jeff?
Right.
The 8082 in the current year versus the, not James, what is it, 6?
6959?
Yeah, that's your 1.1.
Yeah, there, is that
Yeah.
what you're talking about, the total general revenues?
Yep.
Okay, all right,
So we had an increase in that fund then.
right.
Okay.
Well, see, in last year, we had $500,000 from the sale of the airport, and this year we got the 2.2 million included in both of those numbers.
Okay, that's including both of them.
Yeah, both of them. This, so if you drop that by the half, you'd be, you know, whatever, around 6.5. And if you drop this by the 2.2, you'd be around 5.8 or so.
So we still
So it
increased.
actually went
And we
down.
bought
Yeah,
back.
actually went down overall, yeah. The other revenues,
Okay.
right. Property taxes went down 300,000.
But then our total liabilities also decreased since 12.
Okay, so on the entity right, yeah. Yes, that is a true statement. And again, those 550,000 anticipation notes were in there last year.
Okay.
Even though they were current, they're still part of that total liability. So that's a big part of it. And accounts payable, I mean, because the cash was there to pay the payables down. So the accounts payable went down 600,000. And the payments on the debt went down about 50,000. So yes, yeah, there was about a 1.2 million drop in total liability.
Okay. And also some of our loss was self-insured health fund. That was carryover responsibility for nursing home and hospital employees.
That was a big,
$1,106,000.
the loss for the current year, and then I can tell you how that shows up in the entity wide. But on page 21 and 13, you know, there was a loss last year too, but it wasn't as big a loss. But the revenue, and it's on page 20, or, no, yeah. 20 last year, 21 this year. The self-insurance fund, you know, the revenue's down 330,000. The expenses weren't down as much. I mean, they were down some, but the loss, instead of 214, was 409. I adjusted by some interest, so basically that $408,606 of loss shows up. The total numbers don't, but that net loss shows up on your entity-wide statement, page 15, as part of your employee benefit number, the 2.3 million. So yes, that is an expense that's not in your other funds. That's an internal service fund.
Right.
That's showing up here as part of this, you know, loss that we had when you add back, you know, the gain.
And this was just because of us selling nursing home and not having the contributions for those employees
That's
coming
what
into
dropped
that
the
fund.
revenue,
And we
right.
still had the expense.
There's
for-
still some carryover, I'm sure, of
Okay.
those liabilities for the claims. Now, obviously, those claims should go down,
Okay.
you know, going forward. But I think you had somewhat the same issue, maybe not as much on employees you could with the airport probably. That wouldn't have been.
No employees there.
No employees, okay, so I'm not quite sure, you know, we had a loss last year too. I mean, that fund generally should be a break even, or that's what you would try for, but there was a loss last year too. So in the 2 years, you know, it's a $600,000 loss. Now, the carryover balances were there, but now you're down to 84,000.
Right, but we don't have the people to
Right.
take care of now.
Right.
We
I
did.
mean, those expenses, those claims should be down.
Jeff, I think we also made a budget item for this year to actually begin funding that again, did we not,
Yeah.
Phyllis?
Yeah,
So we're trying to build that
Right.
back up
I think
to,
10,000 a month or something
Yes.
pledged into that.
yes.
But you're right, that was a big effect on that front statement that we didn't talk about in the prior meeting when I was here. I didn't point that out, but, if we were looking at, an $885,000 loss, you know, that, I guess roughly about half of that
Half of that was that.
was coming over from that
Okay.
health insurance, self-insurance plan. On the entity-wide, right.
Then I know in our property taxes, our county property taxes have declined 292,000. So countywide, our county share property taxes have declined in the past year.
Mostly IMRF,
Okay.
yeah.
And,
Again, with employees, you know.
right. We also decreased our long-term debt. We've done a lot of good things in the past year.
Well, you know, and I was telling Dave, I was, you know, wish well, a nice thing to be able to provide to everybody here would be that performer I was talking to you about, how they, you know, go through and rate. You know, there's an expense to having them do it, and we don't have the proprietary information. You know, and that's an overall guesstimate on my part that it was about a 5. But some of there's all these different categories, and your balance categories and your balance sheet type categories are probably pretty strong at this point with the sales and with the buildup in those balances and taking care of some of the negative fund balances. It's more on the activity and the income and expense that would probably bring that down. But I'm just we've seen a lot of these, you know, they do these for us, and you kind of see the statement and see how it comes out whenever they take the statement and run it through, you know, their program basically and come up with a rating. And that's kind of where I came up with the 5 out of 10. Some of those categories though probably would be, you know, up a little bit, 7.5.
But we really need to base it on what it was the previous years. You know, if we were a 3 before and we've improved to a 5
right,
or
that's
6,
what this does for
that's
us.
an improvement.
Yeah.
We don't have any, you know, just
Don't
to say
have
we're a
that.
5, well,
But
that
they
doesn't
can
say,
take- they
we
can
may
take-
have been a 1 before.
They can take their old statements and then put them
Okay.
and give you a comparative 3-year, 5-year.
Okay.
You know.
And they usually do that the first
Yeah.
year. They
Yeah.
want some history. Yeah, we usually see 3 to 5 years comparison, and then they keep that, and then you add to it every year.
They have about, I don't know, 15 different categories
They track
that
it.
they track through there, and they give a rating on each one of those, and then they do a combined, obviously, you know, bring it all together. And you know, like I said, I'm just guessing it'd be around that, but you know, your overall, but it's good to look at the breakdown because it really tells you where your strengths are and where the weaknesses are. You know, what, rather
I
than.
don't think we've ever questioned that our balance sheet has strength, you know, and one of the reasons it has strength is we've sold out entities that were not on the balance sheet before, they were outside the balance sheet. So we bring in all this cash that we didn't have appearing on the balance sheet, and it looks like we've got, you know, a lot of money. And from a balance sheet standpoint, there may be truth to that. I go back to 2009 and look forward what we've lost in the general fund. And you look at $2.7 million of continued losses in the general fund. Everything we've sold in hospital, nursing homes, and airports has gone to basically fund that deficit since 2009. That's the reality of what he's talking about on the operating side. That we can't take our eye off it.
But a lot of our losses was because of IMRF and employees we had on the payroll before.
Well,
That was usually
I guess
spent.
we'd have to see it totally analyzed, Jeff. You know,
Yeah.
I'm newer to the board in 2012, but general fund is one set of things, and IMRF, and that is a different set of things, accounts. But, so I think these are great questions, and you need to be discussed. And, so do we have any others? So, well, we have the auditors here, because I see there's other things on the agenda we want to have them talk to us about. Is that it, Dan? Okay, Jeff was in.
Yeah, I covered most everything I had notes on.
Okay, Jim, if you want to talk a little bit about quarterly interim financial statements that we talked about when we got together with you, me, and Jeff, and really what that means to you. Basically, if I could lead into the conversation, and Jim, you correct me if I'm wrong, but basically right now, you are in essence closing our books. And because you're closing our books, you are basically the auditor auditing the auditor to a point. I don't want to make it too simple because you're independent and you have that independence that you must maintain. But in reality, with them having to physically close down our books, you report that every year as a return of weakness, correct? And that will continue. In our conversations with Jim, that Jeff and I had, there was some discussion about if we could have interim statements on an accrual basis, just like our audited statements, that would give us, the county board, on a quarterly time schedule, you know, how the organization's doing, and then have it closed down by the county firm other than them, the books every year, and then they would really audit the work of either, you know, we could either hire a staff person from the standpoint of staff CPA, or we could use a consulting firm to do it. I think that's the conversation we had, right?
Yeah.
And Jim, what's your thoughts there? I didn't want to put words in your mouth, but that was kind of how I recalled our conversation that we had.
Yeah, and that's, we tried to go through and kind of think of the things that we would consider sort of as a non-audit procedure that we're doing as part of the audit to be able to audit the books and be able to produce the financial statement. And first of all, this is not unusual.
No.
You know, not unusual at all. Especially in the government arena, it's difficult to find, you know, where entities that can afford people with the skill, experience, and, you know, knowledge to be able to do all of that on a cost-effective basis. You know, it's just, and we've gone in some cases and, you know, been the reviewer for another governmental entity because they want to be able to get rid of that. You know, I mean, there is some sharing back and forth with firms trying to do that, to accomplish that separation of duties. Yeah. So, I mean, I think it would be great. It'd be great if it's. I mean, it would make our job easier. Your audit costs would be less, no doubt. I mean, I don't know if it'd be $1 for $1. It kind of depends on how efficient they are and how much it helps us, but definitely would reduce the cost of the audit. But the other side of it would give us a much better independence, you know, feeling towards the audit, and you wouldn't have that comment. So you know, just preparing, I think, you know, we kind of tried to include in here, besides all these closeout items, the actual preparation of the document. Now, you know, that's might be a stretch. I don't know. I mean, that's pretty involved to be able to do that. Depends on who's doing it. If it's another accounting firm that does governmental work, shouldn't be a problem, you know, for them to do that. You know, an individual that's coming in, or if you were to hire somebody, I mean, you know, I'm not saying it's not possible, but that could be a little more difficult. But these things would help immensely. These, I don't know how many items are on here, these bullet points, but these would help us a lot. And what we were kind of struggling with as we were going through this was, again, the cost effectiveness of it, because there's a lot of things on here. We kept questioning each item. Do they have to do that every quarter? Well, if you want to look at a statement like this, yes, you would have to. Do you need that full statement every quarter? One in the middle of the year be good enough, and something else? You know, you could really break that down to try to control the cost. Because we mentioned on the last thing, I wanted you to be aware of that you're probably not going to get this with, you know, it'll take a while to do this. It's not like you close your books at quarter end in February and you're going to have this, you know, at your March meeting. I mean, it's probably going to be 60 to 90 days before you see it. So how effective would that be? I mean, depending on how, it just takes a while to put this together. I'm just saying it could be that long, you know, depending on who's doing it. So, you know, taking that all into account, I mean, how soon you get it, whether you could use it in your decision making. I think, you know, if it could be turned around quicker, that'd be great. I'm just not optimistic on that, because there's a lot to do, you know, to do that. I guess just personally, you know, and Dave and I kind of talked through this, I could definitely see a 6-month, you know, take a look at it.
Biannual.
Yes, you know, to really get to a full statement. But some of these things do need to be done as you're going along, you know, tracking things, some of the stuff we put in here, that could be done, you know, monthly, quarterly, you know, whatever, to keep that up to date. But actually preparing the whole statement, personally, I think that's a lot to do 4 times a year, you know. But to really be able to see these good questions we had just now here, you're not going to be able to see that unless it's in this format. You're not going to be able to ask those questions.
We see something once a year that's 120 days after,
Yeah.
after it